All right, here we go. All right, so here's what we have to do today. We're still looking at our discussion about options, and we'll follow that up with our discussion about foreign exchange hedging with options. So let me get the notes open. And when this is done, we may have time to look at a video about what what we're really interested in is when we finish discussing options and futures, we want to start to understand what exactly it is that drives exchange rates in the marketplace. In other words, we know what they are. We've observed them in the marketplace, but the question is what is actually determining the exchange rates that we see in the marketplace? In other words, what exactly are the factors that determine the strength of different currencies? Earlier on, we looked at some quotes way back in the beginning. For example, let's take a quick review of a few of them. We saw that, for example, in February, it took $41.66 to buy a pound. It took 105.45 yen to buy a dollar, and it took about $1.21.56 to buy a euro. The question is why? Why does it cost this much to buy a pound? Why does it cost this many yen to buy a dollar? Why does it cost this many dollars to buy a euro? So that's what we want to address after we're finished with our discussion about options and foreign exchange risk hedging. Okay, so that will be coming next. But right now, we want to get back and review or pick up where we left off in our discussion about options and how they can be used to help us hedge foreign exchange risk. So just a quick review of what we've done already. Remember, there are two basic types of options that we might use to hedge our risks. We have calls and puts. Okay, a call option gives you the right to buy something in the future at a price that's settled on today. And a put gives you the right to sell an option, or sorry, put gives you the right to sell the asset at a price that's agreed on today. Those are the two basic types. There are others, but they're basically hybrids of these two. And these are the most heavily traded options in the marketplace. So just remember, a call is the one that gives you the right to buy something, and a put is the one that gives you the right to sell something. So for our purposes, that something is going to be a currency. For example, I can buy an option to buy the British pound in exchange for dollars in 6 months. Or I could buy a put, which gives me the right to sell the euro in exchange for dollars in 3 months. Okay, so in other words, it's an opportunity for me to lock in the price at which I can buy or sell a currency. And yet, unlike with forward and futures contracts, I could have the right to change my mind. All right, in other words, if I buy the call and later on I realize I don't really need to buy that currency, I can just walk away from this and let it expire. Same thing with a put. If I've originally agreed by buying a put to sell, let's say, British pounds in 3 months, when those 3 months go by, on the day that I'm supposed to deliver the pounds, I can just change my mind and say, no, I don't want to do this. And that's the end of it. But in exchange for these privileges, I have to be prepared to pay a price for these options. In other words, I have to buy them. I'm paying a premium for them. And that's what I'm actually paying for when I buy an option, the right to change my mind. Okay. In other words, I may not want to actually go ahead and buy with a call, and I may not want to actually sell with a put. So the option, unlike the forwards and the futures, gives me the opportunity to walk away from the whole contract. So the premium is the price that we pay for an option, but we have to calculate, before we calculate any prices or premiums, we have to understand the structure of the call payoff and the put payoff. If you recall, the call's payoff is the maximum of S minus X and 0, which basically means that if the price of the currency rises above the strike price, then we'll have a payoff equal to the difference between these two numbers. If not, we'll end up with nothing. Okay, the option will not be exercised and we'll have a payoff of 0. With the put, it was the other way around. Okay, so you recall that we defined the payoff to a put. Let's see. Where do we have that? Here it is. No. hold on a second. Here we go. The payoff to a put is the maximum of X minus S and 0. In other words, if the price of the currency has fallen below the strike price, that means the difference between these two will be positive, and that will represent our payoff. But if not, if S is at or above X, that means the payoff will simply be 0 because we will not exercise the option. Now we started to draw some graphs as well. All right, let me just quickly remind you what they look like. The payoff diagram for a call looks, looks like this, okay? So why is this the case? Because what's happening here is that if we have an option with a strike price of 50, all right, this is our strike price. And if this is a call, that means that the payoff for any price of the asset less than or equal to the strike price, the payoff will simply be 0. Once we get past that point, though, as you can see, the payoff is the difference between the asset price and the strike, which in this case is 50. So in this case, it's simply equal to S minus 50. And that simply means that as S keeps going up, as it does through here, the payoff continues to rise. And specifically, what this means is that in this range, if S rises by $1, the payoff also rises by $1. That's why it looks like this. In fact, this has a slope of 1, this region of the curve, whereas down here, the slope is equal to 0. In other words, it's flat. From this point on, any price of the asset up to 50 means that the payoff is 0. After that, there's a 1-to-1 increase or correspondence between an increase in the asset price and an increase in the payoff to the option. That's why it looks like that. Now, the payoff does not take into account what we actually paid for the option. So when we take that into account, when we subtract the premium paid for this call option from the payoff, the difference between these two is what we're going to call the profit or loss. Okay, because here, unlike the payoff, which can be only be positive or 0, the profit can be negative, okay, or positive. But on the good side here, but losses are limited to the call premium. In other words, if you choose not to exercise this option, all you're going to do is lose what you paid for the option right here, C. So let's say you paid $5 for this option, then the maximum you can ever lose is $5. All right. On the upside, though, there's no limit to how much profit you can make. In principle, S can go up to any number. So as S keeps rising, or profit keeps rising, so there's no limit on that side. But on the downside, we're restricted, our losses are restricted to the cost of the option. So the diagram for profits and losses is slightly different than for the payoffs. All right, so here, these are the profits and losses. And again, here, the curve starts to change shape when we reach the strike price. But you'll notice the basic shape is exactly the same. Here we still have a slope of 1, and here we have a slope of 0. What's different is the location of the curve has been shifted down by the price of the call, which is $3. All right, and so this range down here represents the maximum loss that can occur to the owner of this call option. And again, you can see there's no upside limit. The only thing that's new here is that we have this new spot that we need to take into account. This is the so-called break-even price of the asset, which simply means that this is the price at which the payoff is 0, the profit is 0. And so here you can see that at 53, if S equals 53, the payoff is $3. The cost of the option is also $3. Therefore, the profit is 0. And that's why we call it the break-even price. $53 means we break even. The $3 payoff that we made is just enough to offset the cost of the option. So that's where we break even. But after that, if you notice, as we keep adding 1 to the asset price, we keep also adding 1 to the profits. Okay, so that's the call. Now for the put, everything works backwards. Because remember, with the put, you have the right to sell something. So you're benefiting when the price goes down. With the call, you benefit from the price going up. With the put, you benefit from the price going down. All right, now let's take a look at that. So a put, remember, is the one that gives you the right to sell an asset, which means you're hoping that it does. And again, if S is less than X, we have a positive payoff equal to the difference between the two. Otherwise, the payoff is 0. Okay, but then we also here, like we did with the call, we have to now take into account the actual cost of the put in order to calculate the profits or losses. All right, so from here you can see, just like before, what we did was we combined the payoff, and here we subtract the put price. And so the difference between the two is the profit, and this profit can actually be negative. So profits can be negative, but are limited to the put premium. So that's it. You cannot lose more than you paid for the put, but you can make a huge profit. And in principle, there's no limit to it. So once again, there's a huge upside potential, and there's a very limited downside potential. And by the way, this is one of the reasons why options are so attractive, not just to hedgers, but also to speculators. A lot of people buy options just because they think the value will increase over time. It's not all about hedging, although these securities were designed for hedging. That doesn't mean that everybody is actually using them for hedging purposes. There's a lot of investors who buy them just because they think they'll gain in value. They have no interest in buying or selling the underlying asset. They're just there for the money. Okay, now, we also saw the diagram for the put payoff. Now, just like with the call, the put payoff has a region where the slope is 0, where the payoff is 0. And as the stock price, or in this case, it's the stock, but in general, the asset price keeps dropping. We eventually reach the strike price of the option. And now, as we keep dropping in price, the payoff increases by $1 for every $1 decrease in the price of the asset. Okay, so that means the slope is now -1, not 1, but -1, because it's downward sloping, which reminds us that as the price drops, that's when the payoff will increase. All right, and then we also, just like with the calls, we have to now take into account the cost of the put and construct a profit or loss diagram for the put. And that will look very much like the payoff diagram, except that now suddenly While the shape is the same, it's been shifted down by $2 because in this example, the put costs $2. So once again, here's the strike price. So if the asset price is 50 or up, down here we have our maximum loss of $2. But then all of a sudden, look what's happening as we keep lowering the price of the asset, our profits will go up on a one-for-one basis. And here, the break-even price equals the strike price minus the cost of the put. And in this case, that's 52. And then after that, it's all profit. Okay, up here, the profit is positive. Down here, we have a loss of P dollars. Now, here's one way, though, in which calls and puts are not identical. The one limitation we have here with puts is that the stock price or whatever the asset happens to be cannot be negative. So there is some upper limit here. Eventually, we'll reach that point. So in principle, there is a limit, but it's a very high limit. With the call, though, there's no upside limit to how high this price can go. And so therefore, there's no maximum profit to the call. Now, what we did not cover yet is this. Just like any other security in the marketplace, if I want to buy a call or a put, somebody out there has to be willing to sell it to me. And when they do, they're taking the opposite side of my position, which means that my gains represent that person's losses and vice versa. So whatever I'm making for my call or put, the seller is suffering a loss. But in exchange for that, the seller gets to keep the premium that I paid for this option. So what we want to now is consider the position of the sellers of these options. For example, we'll start with a call. And just be aware that, again, if I if I buy an option that gives me the right to buy British pounds, it's the seller of the call that is going to be the one who has to deliver the pounds to me. So when I buy an option, I'm actually entering into a contract with the seller. I buy, they sell. I'm the one who makes the decisions, though, as the owner of the option. But in exchange for that, I'm going to be paying a premium, which could be very hefty, to the seller of the option. So in a lot of ways, I just want to make the point here that selling an option is similar to selling an insurance policy. When you stop and think about it, the owner of the policy potentially collects a large payoff if something goes wrong. In exchange, the owner of the policy makes premium payments to the insurance company. So in this case, it's kind of the same idea. We pay premiums to the sellers, and if something happens, like the price goes way up or down, we get to keep the payoffs at the expense of the seller, just like when the insurance company has to give you a huge check because you crashed your car. That's the same idea. The payoff belongs to the owner of the policy, not the seller. The seller gets the premiums. The buyer gets the payoffs, if there are any. So let's take a look at how this affects our calculations. All right, so now the formulas that we've been seeing will be a little bit different for the seller than for the buyer. Now, also, when you look at this situation from the seller's perspective, which, by the way, sellers are often called writers. In this market, the word writer means the seller of an option. Look at the position they're in. The writer faces limited potential gains and unlimited potential losses. Would you want to be in that position where you have limited potential gains and unlimited potential losses? I know I wouldn't, but how am I compensated for being in this very risky position? Oh, I get to keep the premium. This is what's compensating me for the risk that I'm taking by being in this situation where I might potentially gain some money, but the downside is unlimited. Wow, that's pretty scary. But I do get to collect the premium. Now, here's the thing, just like with an insurance company, if nobody ever crashes their cars, then the insurance companies will make out really well because they'll keep all the premiums and never have to make any payouts. Just like here with options, if nobody ever exercises their options, the sellers are going to be very happy because they get to keep the premiums without making any payouts. But it doesn't quite work that way, does it? No, there's often payouts with options. And so the sellers have to be prepared to cover large potential losses if something goes wrong. All right, now having said all that, why don't we look at the formulas for payoffs and for profits and losses. Now here, if you notice, if what I'm going to do is quickly remind you what the payoffs were to the option buyer, so you can see them side by side. And you'll notice that there's not much of a difference. And you'll notice the difference is that these are positive and these are negative. That is it. That is the only difference. And the logic here is that the total payoff to the buyer and seller of either type of option equals zero. In other words, if I have a payoff as the buyer, if my payoff is $1, it must be minus $1 to the seller and vice versa. Okay, so the total payoff must be zero. That's why one is simply the negative of the other, which guarantees that they add up to zero. Okay, now what about the profits and losses? How are those formulas going to be different? Let's find out. And again, I will repeat the ones that are meant for the buyers so you can see them side by side. So let's see, let's move this over here. Okay, let me just shrink this up a bit. I just want you to be able to see them side by side. All right, so the profits and losses to the option buyers were very simply the payoff minus the premium for the option. And once again, the total payoff, so total profit to the buyer and seller is zero. Okay, the gains of one represent the losses of the other and vice versa. That's why they have to be structured this way. So that way, no matter what happens, if I make $1, the seller loses $1 and vice versa. Now, here's the fun part. Let's try to visualize what these graphs will look like based on what we've already seen. So if you're unusually good with geometry, you might be able to visualize it, but I'm going to show them to you. And we'll start with the call buyer, the call writer rather. And let's see what that looks like. Oh, now that's interesting. Because remember with the call buyer, it looked like this. So basically, what have we done? We flipped it upside down. That's right, exactly. It's flat up to the strike price, and then it goes down on a one-for-one basis. So the slope is -1, and up here the slope is 0. Remember here the slope is 0 up to the strike price, and then the slope is 1. So I've simply reversed the two. All right, so I'll give you a chance to catch up. Then we have to consider the profits and losses. Okay, so how does that work? Let's jump ahead to the graph. Now here, if you notice, this is 0, by the way. This is my call premium that I've received here. This is my maximum profit. And that would be the call premium. After that, and the slope is 0, of course. Down here, of course, the slope is -1. And I've got a break-even point here. Which is equal to the strike price plus the call premium. Now, once again, I'd like to remind you what this looked like for the call buyer. Very similar, except that it's shifted down by the cost of the call. And so you can see they're basically mirror images of each other. The one on the top is basically the one on the bottom flipped over. Well, now what's left to be considered? How about the seller of the put option? All right, let's take a look at that graph. And you'll see it looks kind of familiar. Here, just like with the buyer, the slope is 0. When the the asset price is above the strike price. And then here, the slope is actually +1. As opposed to the put buyer, and that one looks like this. Oh, that's very bad. Let me fix that. Oh, man. Let's try that one more time. All right, that was supposed to touch on there. So, all right, this isn't too bad. there's the strike. And of course, here the slope is 0. And here the slope is -1. Because, and the reason why that's happening is because we're making money down here as this buyer when the price drops. As the seller, every time the price drops, we're actually losing money. So that's why the slopes have opposite signs. The slope up here is +1, and down here it's -1. All right, now you know what's coming next. We have to now consider the profits and losses. We have to take into account the premium that was paid for this put, and we're going to see what the graphs look like. Well, it should come as no surprise to you that here we are actually collecting the premium when the price of the asset is at 50 or above. This is our maximum profit. And that equals the put premium, which we get to keep. In this case, it was $2, as long as the option is not exercised. That's what we're hoping for. We've got our fingers crossed. Now, the break-even point will occur when we reach the strike price minus the put premium, which in this case is $48. Okay, 48. And then after this, of course, we're losing money like crazy. Up here, the slope is 0. And again, the graph that corresponded to this for the buyer looks like this. Okay, the put buyer. Okay, down here we have a maximum loss equal to the put premium. And then, of course, we keep making money when the price goes down. And then down here, we actually have our maximum loss. Now, what I've done here on the next slide is I have actually put them all together. It's a little awkward. It's not the best drawings I've ever done in my life, but I want you to be able to see side by side the profits and losses for all 4 positions. So you can see what they look like. And how closely related they are to each other. Now, with all these in place, it's possible to come up with some very interesting trading strategies. You can actually take a position in many different outcomes that you could not possibly create with either the underlying asset or forwards or futures contracts. So one of the reasons why options are so popular is because of their flexibility. It's possible to create a lot of very creative hedging or trading strategies that would not be possible with the other derivatives that we've seen. So that's another reason why option trading is so massive, because traders would like to be able to hedge their risks in unique ways, and that's done with options. All right. Now that we've had our introduction to options, now this is just the tip of the iceberg. If you were to take a class where the whole semester was just options and futures, you'd be getting much more deeply into this topic. Here, really all we wanted to know is how do we use these to hedge foreign exchange risk? That's kind of what we're aiming for. It's important to understand how these derivatives work, but for this course, the focus is on hedging foreign exchange risk. So we're about to look at some examples of how this could be done. All right, so let's take a look at these cases, and you'll see how easy it is to hedge with options, but we do have to know what to do, of course. In other words, we have to know under what circumstances to buy a call and under what circumstances to buy a put. So let's take a look at these cases. So we know that they're useful for hedging foreign exchange risk, especially if there's a chance that the exposure that we're worried about will not actually materialize. In other words, if you think you might need to buy pounds in the future, and then suddenly something changes and you don't need to buy the pounds, with a forward or futures contract, you'd be locked into buying them. But here, you don't have to. You can just say, listen, I don't need the pounds, and then you do not exercise the option. So, like it says here, the main advantage to using options instead of forwards or futures is that the hedger is not obligated to buy or sell the foreign currency. If circumstances change, you can back out of it. Okay, you're never obligated to do anything with an option, whereas the forward and futures contracts are binding legal contracts. Okay, you must do what it says in order to avoid legal issues. Okay, so the main drawback, of course, is you have to buy them. All right, now that's something we didn't have to deal with. With forward contracts, there's no cost at all. You just enter into an agreement. With a futures contract, it's true that you have to put money into a margin account, but that's only a collateral. It's still your money. All right. If you don't lose money, you'll get that back at the end. So it's not a true price like an option where you have to pay for it. And sometimes options hedging can be very, very expensive. It's very powerful, but it can also be dreadfully expensive. And so sometimes corporations may decide not to hedge as much as maybe they should because they're worried about paying so much money for their options. It's kind of like the decision as to how much insurance to have. It's nice to have insurance, but it is very, very expensive too. So you have to ask yourself, how much insurance do I really need? And so, the hedging decision comes down to the same thing, cost versus benefit. Anyway, let's see suppose we're in a case where we need to buy British pounds, or at least we think we do. So here's a US importer who expects to need to buy 100,000 British pounds in 6 months. Possibly they've entered into a contract with a British producer in which they've agreed to buy 100,000 pounds worth of merchandise, and that will take place in 6 months. So they know that in 6 months, they will have to go out in the market and buy pounds. Now, the problem with that, of course, is that we don't know what the pounds will be worth in 6 months. So let's just say that the spot exchange rate is $1.50 per pound. So right now, we can buy all the pounds we want for $1.50. The first thing we have to ask ourselves is, what could go wrong? Well, since we're buying the pounds, the last thing in the world we want to see is the price go up. Okay, like for example, to $1.60. If that happens, that means the dollar has depreciated. All right, remember how that works. The more dollars it takes to buy a pound, the weaker the dollar is. So a rising exchange rate, which we would love to avoid, means the dollar has gotten weaker. And if we really think this is going to happen, then that would be the time maybe to buy options in order to avoid this risk. Now, it turns out that when we're worried about the price of an exchange rate going up, that's the time to buy a call option. All right, so we'll see how that works in this example. We buy a call when we expect or worry that the exchange rate will go up. And the reason why we're doing this is because if that happens, we'll get a payoff from the option that helps offset our higher expenses when we pay more money for these pounds. All right, so in fact, why don't I add this in here as a separate slide? We are buying, the hedger will buy pounds, or will buy a call option, because if the exchange rate rises, the option will provide a payoff which can partially or completely, depending on what we do, offset the higher cost of buying pounds. And in that way, it's just like an insurance policy. When does your insurance policy pay off? When something goes wrong. And that's because that's when you need the money. Okay, so they don't pay you off if your car fails to crash. They only pay you if your car crashes, because then you have to fix it or get a new one. The same thing is happening here. We want to set up our positions so that if something goes wrong, we'll get a payoff from our option that helps offset our losses. So then, and again, it's like an insurance policy. Okay, so let's see how this actually works. And again, remember, a call gives the right, but not the obligation, to buy the underlying asset, which in this case is British pounds. So let's just say we look on the Wall Street Journal and we see that we can buy a 6-month call on the British pound with a strike price of $1.50, but the option will cost us 5 cents per pound. So we decide, yeah, it's worth our while to do this. Fine. So that we have to pay, because we're trying to hedge the purchase of 100,000 pounds, that means the cost of the option is 5 cents per pound times 100,000 pounds, which is of course $5,000. So the hedger decides to go ahead with it. $5,000 seems like a lot of money, but it can hedge us from much larger, or prevent us from having much larger losses. All right, now what happens? Well, we're going to think about 2 different scenarios for what can happen to the exchange rate in 6 months. So here, we're assuming that in 6 months, our worst fears have been realized. The dollar has gotten weaker, meaning the spot exchange rate has risen from $1.50 to $1.57. All right, remember, it was $1.50. Let me just add that in here. So that you remember that the price has gone up. And I'll also remind you, the dollar has depreciated. Exactly what we wanted to avoid. So we say to ourselves, oh no, how unlucky could we get? Oh, wait a minute. We hedged our risk with an option. We have nothing to worry about. So how would that work actually in practice? So on that date, we exercise the option and we buy 100,000 pounds for $1.50, which was the strike price. That part cost us 150,000. But we also paid $5,000 for the call. So that means the total cost of buying the pounds and hedging the risk is $155,000. So you might say to yourself, well, did we do the right thing? Should we have bought this option or not? And the answer is yes. Why is that? Well, that means we're paying the equivalent of $1.55 per pound. Whereas if we did not use the option, we would have had to pay $1.57. Okay, so without the option, the total cost would have been, and then we have to multiply 100,000 pounds by $1.57. All right, and so you can see that, yes, we'll end up saving money thanks to our cleverness in hedging our risk in the options markets. All right, so that would have cost us $157,000. So therefore, we conclude that by entering or buying this call, we've saved $20,000. In other words, 2 cents per pound times 100,000 pounds is $20,000. And so we congratulate ourselves for being so clever. All right. There we go. So the hedger now feels very happy. It turned out that our worst fears were realized. The dollar did depreciate, and as a result, we would have had to pay 157,000. Instead, we were only forced to pay 155,000. Very nice. Now, here's the other thing too. What if the price had been $1.67 or $1.77 or $1.87? In all of those cases, we still only pay $1.55 per pound for our British pounds through the option. So no matter how high the exchange rate went, we would have locked in a cost of $155,000. Nice. So here we only saved $20,000, but if the exchange rate had gone up even more, we really could have saved a lot of money. Now, let's look at another situation. In 6 months, in this case, the spot exchange rate has fallen from $1.50 per pound to $1.42. In other words, the dollar has appreciated. Is that a problem for us? No, because now you see what's happening here. This is actually the best case scenario for this hedger, because look what we can do now. We can go in the market and buy 100,000 pounds and only pay $1.42 each, which means we're paying only $142,000. Well, so in other words, this is the case where we do not exercise the option. We changed our mind. It doesn't make any sense now to pay $1.50 per pound when they're only worth $1.42. Now, once we include the cost of the option, that means we're going to pay $147,000 for our pounds. And that is saving us some money, because you can see that had the price stayed at 150 or above, we would have had to pay $150,000. So what this implies is that, unlike with the forward or futures contract, we were able to save money in spite of the fact that we had this option in our hands. And so we're happy now because the option let us save money when the dollar got stronger. Yes, and again, if we, instead of buying that call option with $1.50 strike, what if instead we'd enter into a forward or futures contract with a price of $1.50? Then we're going to pay $150,000 no matter what happens in the market. So therefore, this proves to be a clever move, because compared to those contracts, we're saving $30,000. Okay, because we're paying 147 instead of 150. Okay, so either way, we're better off, aren't we? Why, yes, we are. How do you like that? Now, on the other hand, let's look at the perspective of somebody who needs to sell currencies. Oh, and of course, we'll just wrap this up here real fast. The advantage of using a call to hedge the purchase of an asset is that the hedger saves money if the price goes up. Goes down, but locks in a maximum price paid if the price goes up. Okay. The drawback is that we have to pay for the option. I mean, that's really the only drawback. We have to pay for this. Okay, now we're ready to consider the perspective of the hedger who is selling pounds. All right, what do I mean by that? What if we have an exporter? Now, the exporter makes their money by selling goods in the United Kingdom. Okay, let's say this is Starbucks and they have Starbucks all over London. The British customers are paying them in pounds. Okay, if you walk into a Starbucks in London, the prices are all in pounds because they're in England. So Starbucks will have all of these pounds that need to be sold. And let's just say that for whatever reason, they know that in 6 months they'll have to sell exactly 100,000 pounds. And once again, we assume that the spot exchange rate is $1.50. And what we're worried about here is that the price goes down. Okay, in other words, this is the opposite of what we had before, because let's say it goes down to $1.40, our total revenues will only be $140,000 rather than $150,000. Not what we want at all, is it? No. Okay, so now, because we're going to be selling pounds in the future, rather than buying a call, we're going to buy a put. Why a put? Because if something goes wrong, like the price falling, we will get a payoff from our put option. All right, so what we can say here is that the hedger uses a put because if the exchange rate falls, the put will provide a payoff that will partially or completely offset the losses that occur from selling the pound at a lower price. Okay, so in other words, just like with the call that gives us a payoff if prices go up, this gives us a payoff if prices go down. All right, now having said that, we have two scenarios. So that, remember, the put option gives you the right to sell the underlying asset, but never the obligation. So let's just say that to keep things simple, there's a 6-month put on the British pound that we can buy with a strike of $1.50 and the price of a nickel. All right, let's look at our two scenarios. Oh, and by the way, this option then also costs $5,000. We have to take that into account when we determine our payoffs and profits and losses. All right, now suppose that the exchange rate goes up. And from $1.50 to $1.57, just like we did in the other case. The hedger, now remember, these are the sellers. The exporter has pounds to sell. The exporter is not going to sell pounds for $1.50 with his put when he can sell them in the open market for $1.57. So therefore, the seller or hedger will sell the pounds at the market price of $1.57 and receive $157,000. Now, once we take into account the cost of the pounds, that means our net revenues are $152,000. Which is not bad, considering if we'd enter into a forward contract, we would have had to sell the pounds for $1.50. But instead, because it's an option, we get to keep the extra profits when the price goes up. Okay, so it's $1.52 per pound. Not only that, but look how nice this is. No matter how high, if the price keeps going up, let's say it went up to $1.80, that's all profits for us. All right, we're only going to pay, I'm sorry, that's going to be in our pockets from the market, regardless of the option. So we just keep collecting more and more money as the price keeps going up. But look what happens here. Now, this is the one we were worried about. we're going to have to sell in the spot market our pounds for a measly $1.42. And so we'll note that the dollar has appreciated. Now, this is the case where the hedger says, all right, well, we're going to exercise the option and we're going to sell the pounds for $1.50. That will bring us in $150,000. But the put did cost us $5,000. So our net receipts are $145,000. Now you might say, well, what's the big deal? But we would have only gotten $142,000 had we not bought the option. So that just brought us in an extra $30,000. That's not too bad because we had enough foresight to hedge our foreign exchange risk. Yeah. And not only that, but no matter how far down that number goes, we're still going to be able to collect $145,000. Okay. So that's why we like this so much. It says, listen, you'll never have to receive less than $145,000, no matter what happens to the exchange rate. Okay. So the summary here is that the advantage of using a put to hedge the sale of an asset is that the hedger can save money if the price goes up. And we can lock in the minimum price that will be received the asset if the price falls. The drawback, of course, just like before, is the cost. We have to pay that premium whether or not the option is exercised. All right, so in a nutshell, this is how hedging foreign exchange risk with options works. And you can see it's quite a very powerful and flexible tool for hedging our risk because it not only enables us to prevent our costs from going up or receipts from going down, but it also means we can take advantage of changes in the market, which is not possible with forward and futures contracts. Okay, now the next section of this chapter, as I mentioned earlier, the one thing we have not yet considered in our discussion about foreign exchange is where do these spot exchange rates come from? Okay, in other words, why are the exchange rates at the level that we see them in the marketplace? Well, just like all other financial assets, we can make the case, which we will in a minute, that ultimately the values of these currencies come from supply and demand. Now, of course, if you've had an economics class, you already know quite a bit about supply and demand. If not, that's okay because we're going to go over it here as well. But we're going to start by claiming that the ultimate source of the value of a currency is nothing but supply and demand. Okay, the more people want to buy a currency, the stronger it will be. It's really just that simple. But before we dive into that, it just so happens that we have a video to introduce this topic. So let's take a look at it. And oops, that's not the right one. Let me go grab the right document. There we go. And we're going to be looking at an introduction to supply and demand in the foreign exchange markets. All right, so let me just send this off to you and we'll take a look. All right, there it is. Let's check this out.
Common bond.
Okay, is that done? All right, so that did go by kind of fast. Why don't we start from the beginning and see what exactly that was all about? So, again, this is all about supply and demand, which, again, you may have seen it in another class, maybe not. It doesn't really matter. We'll assume that you've never seen this before. So, just like any other asset, there is a supply and a demand for foreign exchange or foreign currencies, and that will ultimately determine the strength of the currency, just like any other asset in the economy. Now, we'll start with the demand. Now, the demand for currency. Now, think about this. Like you said in the video, Americans don't demand dollars. We have dollars. Foreigners, though, need dollars to buy American goods and services, and they need them to buy US investments. In other words, if a foreigner wants to buy American stocks or American bonds or put their money in an American bank account, they have to buy dollars with their own currencies, that is. Or if a foreigner just simply wants to travel to the United States, they need to buy dollars. So the demand for dollars really does, I mean, nobody buys the dollar for its own sake. The dollar's demand comes from the demand for goods and services and financial assets in the US. So we say that the demand for dollars is derived from the demand for American goods and services. So in other words, it's basically a way of foreigners acquiring American goods and services as well as our financial assets. So on the other hand, oh, this is just an example. Okay. So for example, now on the other hand, we also demand foreign currencies, don't we? Americans demand British pounds in order to buy British goods and services and to invest in British stocks and bonds and bank accounts and et cetera. For example, if Starbucks wants to start up another chain in another store in London, they have to buy pounds, okay, because they have to pay for everything with pounds in England. So the demand for a currency is ultimately coming from foreigners. So you can probably imagine what this means then is like, for example, because everybody throughout the world loves iPhones, the fact that everybody wants an iPhone means that people have to, exchange their own currencies for dollars in order to buy iPhones, and that will strengthen the US dollar. Okay, so, or if people want to buy American stocks, all right, they think that Amazon or Apple or any of the other American stocks is going to go up, they need to trade their own currency for dollars to buy American stocks. So, to the extent that the US economy is strong, that the markets are booming, and their goods are in demand by the rest of the world, the dollar should stay relatively strong. Okay, because the reality is foreigners want our products, they want to invest here, and that means they have to buy dollars. And in general, just all other things being equal, the more attractive our goods and services, and the higher the potential rate of return to our financial assets, the more foreigners will want our dollars, and the stronger will be our currency. Okay. Now, if you've seen this before, you'll know what I'm referring to. The demand for a currency can be illustrated with a special kind of graph. We're going to create what's called a demand curve, and that will show the quantity of the currency that people are willing and able to buy for every possible value of the exchange rate. So one thing I do want to remind everybody that is that the exchange rate can be thought of as the price of a currency. So in other words, the reason why we can use our traditional supply and demand curves where we have price on the vertical axis is because the exchange rate itself is nothing but the price of our currency. It means the same thing in this context. Exchange rate and price are the same thing. All right, don't you worry. You'll understand when you see the graph. Now, of course, as with any other demand curve, in fact, why don't I quickly show you an example of this right here. Suppose we're thinking about dollars and pounds, and we're thinking about Americans' demand for pounds. How about that? So we'll have here the exchange rate, dollars per pound. And then over here, this Q represents the quantity of pounds. This is the exchange rate. It represents how much an American has to pay to buy a single British pound. The demand curve would be downward sloping. And when you think about it, it makes perfect sense. Suppose that the exchange rate at the moment is $1.50 per pound. And at that price, Americans are willing to pay, I don't know, let's say this is millions. It's not going to be 10 pounds for the entire economy. Let's say this is in millions. So let's say that every day at this exchange rate, Americans are willing to buy 10 million pounds. Now, if the price goes up to $1.60, in other words, the exchange rate goes up, which means a weaker dollar, it now costs us more to buy British pounds. And so naturally enough, we'll buy fewer pounds. Let's say we only buy 8 million of them, because now it costs us more money to buy British goods, and we may turn around and buy more American goods as a result. But on the other hand, if the opposite happens, there's a stronger dollar, and therefore it suddenly becomes cheaper to buy British goods, and therefore we buy more pounds in order to acquire those goods. And so you can see that the price of the exchange, or the currency rather, and the quantity are going in opposite directions. So here, the exchange rate and Q move in opposite directions. Which implies a negatively sloped demand curve. All right, so as long as you can think of this as a price, the price of the pound, then this is just like any other demand curve you've ever seen in your life. It goes downward because at a higher price, we buy fewer of the product, in this case, the pound, and as the price goes down, we buy more of it. Now, how about the supply? The supply of a currency comes from the citizens of that country. So the supply of British pounds, for example, to the United States depends on how many goods the British are willing to buy from the United States. Okay, so in other words, you and I as American citizens, we do not have access to pounds. They have to come from England. It has to come from people in England who buy American goods and services, or else who invest in American financial assets. So the supply of a foreign currency has to come from foreigners. All right. So in other words, if the British like our products, they'll buy a lot of American, they'll trade their pounds for dollars to buy American products. And it will show you that in a second with a supply curve. Now, the more attractive our goods and services are, and the higher the return to our financial assets, the more of that currency we should be able to obtain. Okay. Now, what this builds up to is a supply curve that we can define for the British pound. And you'll see it's like a traditional supply curve. It's actually going to be upward sloping. Okay, now, just like the demand curve, the supply curve shows the relationship between the exchange rate itself and the quantity of the pound that the British are willing to sell at every possible exchange rate. All right, so let me just quickly show you a graph of that. All right, so the same thing is on the vertical axis, the exchange rate. We'll call that the quantity of pounds. What am I doing? This quantity means pounds. Okay, and if you're not sure, just remember, we decided to define this as millions. Just think of this as the price of the pound. How much does it cost an American to buy a pound? So the supply curve looks like this. So let's say at $1.50, the British will supply us with 10 million pounds. Down here, this is a weaker pound. And the British will be willing to supply us with fewer pounds. In other words, they will buy fewer American goods and services because they're more expensive. On the other hand, up here, we have a stronger pound. Which means that they get more dollars for each pound that they bring into the US. And that means buying American products is cheaper. And here we go. As a result, they're going to buy more American goods. But in order to do that, they have to provide us with pounds, or they have to provide the foreign exchange markets with pounds in order to get those dollars. So the supply curve is upward sloping, and it has a positive slope, just like any other good or service you've ever seen in your life. And then finally, we're going to bring them together and see how they interact with each other. And we're going to introduce an extremely important concept, which, if you've never seen it before, is called equilibrium. Okay, this is a critically important concept in economics. Equilibrium. It's every type of analysis you do in economics ultimately comes down to equilibrium. And really, all that it refers to is a balance between the quantity of something that's being supplied and the quantity that's being demanded. So let's see what this would look like. We're just going to bring them together. Now, I swiped this out of the book, as you can tell, because their graphs are much better than mine. But this is exactly what we were doing earlier. This is dollars per pound. And this is the quantity of pounds. Okay, right there, billions of pounds. And the exchange rate quoted as dollars per pound. This is the supply of pounds, which is clearly upward sloping. And this is the demand for pounds, which is clearly downward sloping. So because they're both straight lines, they have to cross at one point, and that point is what we mean by equilibrium. It's a very fancy sounding Latin word that means a balance of some kind. And what is the balance here? This is the balance between quantity supplied, which I'll write as QS, and quantity demanded, which I'll put up here somewhere. QS is quantity supplied. And QD is quantity demanded. When they're equal to each other, we have what's called equilibrium. And so here, the equilibrium exchange rate is $2 per pound, and the equilibrium quantity is 3 billion pounds. Okay. That is the only place where everybody's happy. Okay. The British are providing us with as many pounds as we're willing to buy, at that exchange rate. Anywhere else, then we're not in equilibrium, and the exchange rate will have to adjust to assure that we are back in equilibrium. Okay, so does this look familiar? I mean, has anyone here never had an economics class? I know you're not necessarily economics majors, but I'm hoping that you've at least had an economics class before, whether it was macro or micro, it shouldn't matter, because you should have seen this before. All right, now, oh, here we go. You have, all right, that's fine.
Oh, yeah, all of us probably have.
Yeah, okay, that's cool. It's just that you haven't seen it applied to currencies before. All right, well, then the next two parts should be completely familiar to you. What happens if the price is not in equilibrium? Let's jump ahead of here a little bit. What if we have this situation? What if the price is too low to be in equilibrium? What's going on here? Well, the quantity demanded, in this case, exceeds the quantity supplied. We call that a shortage. And so what will happen is, because the price is so low, people want to buy more pounds than are being made available to us by the British. And so that will put upward pressure on the price. We'll move up the supply and demand curves until we find ourselves back in equilibrium. And this will happen automatically. And because we know that the volume of trading in the foreign exchange markets is so massive, this should happen more or less instantly. The minute there's a discrepancy, traders will take advantage of it, and we'll see that the exchange rate should quickly move back to its equilibrium level. Now, the other extreme opposite case from this is when the price is too high, and that is referred to as a surplus. I'm jumping ahead again a little bit here. And here you can see the quantity supplied exceeds the quantity demanded. And that means the British are providing us with more pounds than we really want. And so the price will have to drop. And as a result, we'll find ourselves pretty quickly back in equilibrium. And again, this should happen very quickly in this market because it is so massive. There's so much trading taking place. In fact, unlike the stock markets, the currency markets essentially never close. They're open 24/7 for the most part. And so you can rest assured that as soon as something like this happens, there'll be a very quick change. And before you know it, we'll be back in equilibrium. All right, well, since you're all so familiar with this, that's wonderful. So we don't have to dwell on this too much. What we want to consider then after this is what happens to the economy when these changes do take place. And then we're going to introduce some very interesting ideas, but sadly enough, it's almost time to go. So I'll tell you what we'll do. Let's see, it's already Thursday, got it. Why don't we let's stop right here and agree that we'll just pick it up right here next Monday, and we'll carry on with our discussion of foreign exchange. Okay, now fairly soon it's going to get even more complicated. So, so far so good, I hope. And so then I'll just see you all on Monday.
Thank you.
All right, you're welcome.
Thank you. Have a good day.
Thank you.
Okay, all right, bye.
Professor, I have a quick question.
Yes, okay.
So, around when do you think we'll have our first exam?
I'd give it at least 2 weeks, maybe 2 more weeks.
Okay, thank you so much.
All right, bye.